An $8 billion valuation, a celebrity-backed launch, a glossy ad campaign. And within months, investor money vaporized and a flagship product failed to deliver. One company's mistakes didn't just bankrupt investors, they exposed an industry's bigger problem. Here's how that collapse rewired the entire EV market. This is not a car review. It's a playbook of mistakes, hype, poor engineering choices, failed supply chains, and an influencer ecosystem that magnified every single fault. If you build an argument around image instead of product, markets will punish you every time. Let's look at the fast timeline. It started with massive funding rounds, which led to high-priced pre-orders. Then came the production delays, followed by a wave of negative reviews and recalls. And finally, a total revenue collapse. Our thesis is this: when big capital, slick PR, and weak engineering meet, one video or one major review can accelerate failure, but it's only the spark. The fuel for the fire is structural. The problems were there long before the public noticed. The first reason for this spectacular failure: overhype. Investors poured money into a brand narrative celebrity endorsements, flashy pre-order numbers, and headlines celebrating the company's sky-high valuation. That capital looked great on paper, but it was poorly allocated. Instead of going into robust engineering, production, and quality control, it fueled marketing. The result was sky-high expectations from the public, but an incredibly low tolerance for any mistakes. That brings us to reason 2: manufacturing failures. The leap from a cool prototype to mass production is gigantic. It requires a solid network of suppliers, specialized tooling, and contingency plans for when things go wrong. When suppliers lag or your quality control fails, small defects quickly compound into massive, expensive recalls. Most startups tragically underestimate these costs and timelines. As production delays mount, their cash burn rate just explodes, putting them on a fast track to disaster. It's a classic case of promising the world before you've even figured out how to build a single, reliable unit. Which leads to the third major problem: a complete misread of product-market fit and pricing. Selling premium features at thin margins, without a scalable service network of service centers and spare parts, is a recipe for customer complaints. Consumers who pay a premium price expect durability and support. When the first early adopters start reporting major problems online, that social proof collapses almost overnight. The very people you counted on to be your ambassadors become your biggest critics. And finally, the trigger that lit the fuse: influential reviews and viral negative posts. A single high-profile review from a trusted source that highlights serious reliability or safety issues acts as a powerful accelerant. It can change public perception overnight. This often prompts advertisers, partners, and dealerships to distance themselves from the brand, which in turn chokes off revenue and any remaining lifeline the company might have had. The consequences were swift and brutal. Pre-orders were canceled en masse, investor sentiment collapsed, and stock prices plummeted. Credit lines were tightened or cut off completely, and dealerships pulled their support. It's this financial squeeze that often triggers insolvency, not necessarily the initial product issue itself. The house of cards comes down fast. So, what did the industry learn from all this? The lesson for the EV industry and for anyone investing in it is simple: hype equals risk. Durable, long-lasting companies build engineering margins, redundant supply lines, and solid customer service networks before they scale their marketing. Fast growth without resilience is just a house of cards waiting for a slight breeze to knock it all down. If you want to spot the next potential collapse, here are the signals to watch for. Heavy PR and marketing spend relative to the capital invested, repeated announcements of production. Delays, negative reliability reviews from reputable outlets, and key partners publicly withdrawing their support. When you see these signs, it's a major red flag. This wasn't just one company's failure, it's a structural warning for an entire industry that is often fueled by hype. If you want a deep dive on the specific supply chain numbers or the one review that triggered the final collapse, Let me know which one you'd prefer in the comments, and we'll publish a follow-up. Subscribe for more weekly explainers on the economics shaping our tech world. Thanks for watching.